People need an income that's guaranteed to them.
If you lose money to taxes, you never get that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees, they don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, find us, as always, at zinniawealth.com, ZINNIA wealth.com. And we talk about retirement here on the show. There's going to be a time when you walk away from that 9 to 5 and you walk into this thing called retirement. And then all of a sudden you say to yourself, okay, how am I going to get paid? And that's what we talk about here on this show, and navigating all the things that are after your money. One of them is that stock market, and we certainly have a lot to talk about there today. Charisse, how are you doing today?
Oh, having a great week. School started.
Yeah.
And the market's been bobbly, and everybody, actually, we haven't gotten any calls in our office. Actually, I think we got one, but it was for something else. But, you know, when the epicenter over at Japan, where, you know, the Bank of Japan raises rates as high as they did, it causes a tumbling effect all the way to the United States, right? Mm-hmm. So there's a lot of noise out there. We also heard Warren Buffett and his team sold half of his Apple. People are panicking. They're like, do I sell my Apple? Do I keep my Apple? And we never sell based on whatever Warren Buffett does, because he's a billionaire and what he's doing is not what we're doing, right? So a lot of noise, and that's what we want to talk about today, because it's scary and exciting at the same time, because it could be an opportunity zone here. And so we just want to ease the pains and the thoughts this week and kind of collaborate and give you some thoughts.
Well, I think that the big question that everybody wants to know is, you know, is this a one-off, or is this the start of something bigger? The fact of the matter is the market does three things. It goes up, it goes down, it goes sideways. And we forget sometimes it does go down. So we saw 2 days where the market went down 1,600 points in 2 days. And then we've been kind of inching our way back a little bit this past week and so. And so what is going on here? This is one voice from CNBC. He's from UBS. His name is Scott Zelnicker, and he said, you know what? We were kind of overdue for something like this to happen.
The markets haven't had a pullback of more than 5% in over a year. That's not normal. 10% pullbacks are normal in a given year. History shows that a 10% is once a year, 5% is at least twice a year.
All right. So I think he's right. You and I have talked about what a great year 2024 has been in the market, and then all of a sudden a little blip, and this is kind of the nature of the market, isn't it, Charisse? If you're going to play there, you got to know that this could happen.
Definitely. And I think a lot of people were hoping the Federal Reserve was going to lower rates a little bit, especially after hearing about the Bank of Japan, and it moves markets. Wall Street doesn't like the unknowns, and neither does the individual investor. And like you said, Randy, markets go up, they go down, they go sideways. If you're going to play that game and you're going to chase this tail of the rocket ship, eventually we're going to get burned. Mm-hmm. Sometimes we get burned a lot worse than other times. And I would call this a slow burn, right? Mm-hmm. Because the slowness of the noise of, you know, the election and everything that has evolved, and Japan and Warren Buffett. I mean, there's so much noise out there. So the question is, if you don't like the noise and you can't handle it, that just means it's a possibility. You just don't have confidence in your plan or yourself, or maybe the advisor you're working with, and knowing what the exit strategy is and what the plan is when times like this happen, I think gives people such peace of mind. So I do feel bad for those who aren't sure or making bad decisions, because what you're asking is, Charisse, pull out your crystal ball. Is there a market crash? Are we going into a recession, or are we not? that. And of course, I cannot predict that. I see a lot of math behind the scenes. I see that unemployment rates rose. That is not positive, right? That makes the market move down when we hear noise like that, and when we hear that all the data we have been fed the last 9 months was BS and they didn't calculate it right, or it wasn't, it's just concerning. Let's put it that way. And right when we thought we were growing all these jobs, we really weren't. So we're starting to tick in little bits at a time. We saw bankruptcies this year. We've seen companies close. And even though markets keep going up, a lot of the stuff behind the scenes isn't looking as pretty. And we could go a long time, Randy. I mean, we could go maybe a year. I mean, I don't know, maybe 2 years and keep fluffing and faking along. But then when we see big companies shutting down, we see all this other stuff evolve, we will see the big hit eventually. And it could be a hyperinflation hit. It could be anything, right? It could be war. I don't know. But I will tell you that markets do need to take a break. We can't always keep going straight up. We need these 5 and 10% corrections, sometimes 15% corrections, so we can get up again and go further up. That's how the cycle works. And so the people who are panicking more or less are people who are living on their money. I sat down with somebody, Randy, literally this past week, and they were telling me that they get $5,500 a month from their investments. And I said, well, do they sell 1 year's worth of cash, put it there, and then they just pay it out to you every month? And they said, no, every month they go and they sell. I said, so you're telling me to get your income next month, they are selling right now when the market is down. Mm-hmm. And they went, yes. I said, that's a cardinal sin. Yeah. And they went, we've been listening to you for years. We know. Yeah. We talked to Fisher Investments about it, and that's just what they do. I went, oh, dear. Because we have been taught all these years, financial conventional wisdom, never sell when the market goes down. That's a paper loss. Yet we have the country selling when markets are down right now to give you income next month. Like, that is wrong. That's not how it should work in retirement. But every company has their own philosophy, right? That just means there's no leverage. There's no bouncing from one investment to the other. When the market's crashing, you don't pull from that account. You pull from another account where it actually maybe went up, or maybe it just didn't go down, period. So, again, there's a lot of noise, Randy, right? I don't know, Randy, did you follow the VIX this week?
Oh, my gosh. It went up. Let's see. I actually compared it to back in 2008, and the VIX in 2008 was like at 89. That was the highest I think it's ever been, but it got to 62.
And during COVID, it got to 65-ish.
Yeah, so it was pretty nutty.
So this is how everyone wants to know, what is the VIX index? It's the consumer index. I call it the fear index. And all we have to do is look at it every day and see it ticking up or see it ticking down. And normal levels are between like 17 to like 25. And when it starts to go up, we're watching it. I'm like, ooh, 35. This is the consensus around the United States is not good for the average individual. And then it starts to go to 40 and then 60. But if it stays up and it doesn't go down, it helps us make some moves in what we're doing here internally. So if anybody has ever heard of it, but just know it's out there. It's just another way to weigh in and scale in what's going up. But it went straight up and it went straight down. So, people were scared because of Japan, because of the interest rates, and then it dropped right back down. So I feel a little better about that. So this could be a time for you guys to start to create your shopping list, right? If you are risky investors, or you like to take opportunity when it presents itself, get your list out, whatever stocks you like to buy. If you already have some, you want some of the same ones you have, maybe it's the time to do that. If you're on the opposing side and you're like, Sharice, that would scare me. I don't even know if the market's going to go down. I just know I don't want to lose. I don't think that's a good strategy for me. I have another shopping list for you. And we just saw a fixed rate at 5.7. If you don't want to be in the market, I got a 5.7 fixed rate guarantee for you. So again, supply and demand, there's going to be big changes. Right now, there's some amazing opportunities in the fixed rates with no fees. I'll take 5.7% all day long and not have to charge a client for it. So take opportunity, because as soon as the reserve starts to lower the interest rates, those 5.7s won't be here. The banks, if you're getting 5 or 5.5% from the bank, Randy, do you think when the Federal Reserve starts lowering rates, those rates are going to go down for the people who are renewing? Yes. So opportunity is here. Don't let it go. Don't do what happened during the time period where we had home interest rates down to 2.5%, and now you can't get those rates anymore. And take the time to do your homework and come in and sit with an advisory team that makes sense to you so that you can get these things while they're still here.
Well, you bring up a great point. Is there anything wrong with companies like Nvidia or Amazon or Microsoft or Apple right now? No. But maybe they were overvalued in the stock market, and that had to come down a little bit back to the mean, and that means there is a buying opportunity. The other opportunity that you see is if you lost money, and most of us did over the last couple of days, you might want to re-look at your risk level in the market, and that is the next person that I want to play here. This is Steve Sosnick, and he's on CNBC talking about, as you get toward retirement, dialing back your risk and being a little bit more defensive.
Right now, you want something that's a bit recession-proof, because the bond market, with the moves that we're seeing, they're screaming at us right now to tell us that they think we're looking at a recession. So this sort of bodes for a bit more of a defensive posture until we can really see if this is a temporary storm or bumpy landing, so to speak, or if it is indeed a harder landing.
So we talk about this a lot, Cherise, knowing your risk level, getting a comfortable risk level there, and that brings up the whole 60-40, 50-50, 80-20 portfolios and all the mix that goes along with that. But when he says those words, we need to take a defensive posture, or we need to be defensive with your portfolio, what does that mean to you in nuts and bolts? How do we create that?
So some people come in, Randy, when we do our portfolio x-ray, and they'll have 100% of their portfolio in bonds. Mm-hmm. Some people come in, they have 100% of their portfolio in equities, which is high risk, right? Mm-hmm. Some people come in and it's diversified, or sometimes they have a 50-50 split, 50 in bonds, 50%. And most people think bonds are safe, and they have been safe for a long time. But when 2022 came and interest rates shift gears, bonds started dropping, right? An average of 4 to 6% every time interest rates went up 1%. So now bonds are screaming, just like we've heard all over the news, and it's probably not one of the best ways to get a safe, reasonable rate of return because of this bumpy ride. It's all dependent on the Federal Reserve, if they raise rates or if they lower rates. And there's a lot of things happening. And right now, depending on what inflation's going to be like, if they're trying to keep inflation down, they're going to lower rates. If they go back into the world where, inflation is beating the heat out there and they have to raise rates to bring it back down, it makes it a very hard place for the bond market to make money. And if bonds only average 3% over the next 5 years, it's probably not the best place to park your money. Yeah. And so we have to be careful. And this is why we really started pulling away from the bond market and using the other alternatives. Because if I can give you 5.7% for the next 5 years with no fees, no volatility based on whatever the Federal Reserve does or the market does, I really truly don't think we're going to have that kind of return in a bond, right? And I can't predict that, but give me something stable and predictable. That's the direction. So we had to shift gears and make some big changes here at Zinnia Wealth Management because of that fact. People are counting on us to make money. They know if we have money in the market, we're going to take some losses, but they also want to make sure their income is stable and is ready. And there's something that's not bobbing and weaving so they can live on those dollars so they can show up every day when they decide to take that monthly paycheck. So it's just thinking through the economy, thinking ahead. What are we seeing? We can't predict, as we said prior. I can't predict when Warren Buffett's going to sell another, slew of Apple, right? And it moves Apple down. If I knew that, I'd be like a billionaire and the entire world would be investing with us, right? If I knew ahead of time Warren was going to be selling, well, I would have said, okay, everybody on radio, sell. Warren's about to sell. We would have capitalized. And then when now Apple's down, well, guess what? Let's get in now. It doesn't work that way, right? That's the realistic part about being in the market. And we don't know when CDs are going to lower the rates. I know when the markets go down, short-term treasuries go up, right? But even the short-term treasuries are even changing as we speak. So it's a lot of noise, and you could be listening to Dave Ramsey, you could be listening to Susie Orman, you could be listening to all these gurus. You can listen, you do need to be proactive and take action and maybe pull and plug a little bit from everybody. But they're talking for the masses. They're not talking for you, the individual who's listening to this radio show today.
That's a great point. We can listen to all the experts out there, and we can watch CNBC, and we can watch Fox Business. But the fact of the matter is you're going to be different than everybody else. A lot of times those are big, broad brushstrokes, generic things that they talk about. We're not going to know what's right for you unless we actually do your math. We talk about it every single week here. Come on in. We'll do that portfolio x-ray for you at no charge. If you are getting close to retirement and you just went through a week where you lost money and you say to yourself, man, if I was in retirement right now, I don't like this. Well, this is probably going to happen sometime in your 20, 25-year retirement, maybe numerous times. Let's build that moat around your castle and all that you've saved before you get into retirement. Give us a look on our website. Give us a call. ZinniaWealth.com is our website, ZINNIA Wealth.com. In the lower right-hand corner, there's a gold box that says Complimentary Retirement Consultation. Just click on that, and you'll be on your way. Or give us a call at 833-368-3680. That's 833-368-3680. All right, so we talk about what people do during times like this. Sharice was just talking about all of us watching Warren Buffett. One thing Warren Buffett did was he sold a whole bunch of stocks, and now he is flush with cash. That is one thing that a lot of people will do is they'll push out of their equities. They'll even move 401k money over to the cash pile. I'll just sit on the sidelines and wait this thing out and then go back in. Let's talk about you and your cash and sitting on the sidelines waiting for the opportunity. That's next on Retirement Coffee Talk. Welcome back to Retirement Coffee Talk with Sharice Rivers and Zinnia Wealth. Online, ZinniaWealth.com, ZINNIA Wealth.com. If it's time to talk about your retirement, give Sharice a call and let's talk through your concerns. Do the math on what your retirement's going to look like. Just kind of open things up and say, okay, here's what you're in for. How are we going to plan for it? Again, ZinniaWealth.com or 833-368-3680. All right, so we said before the break, one of the common things that people do during times like this is as the market goes down, they say, I'm going to cash. And they push it all over to that cash pile, and then they wait to see when they want to get back in. Sharice, it's very common. Tell me why this is a good idea or not such a good idea.
I think it depends on your season of life. If you are nearing retirement and or in retirement and you have, 10 stocks and you just say, I'm going to go to cash. I made 20% on these stocks and I'm going to wait for an opportunity to go back in. If you are that good, then go do it. If you are a day trader, or let's just say you're a weekly trader, you every Wednesday buy and sell stuff. I've met lots of you, and you're going to be focused and follow your rules and do it each week, then do it, because we don't want to take that away from people, especially if you're good at it. But the average person, the 99%, maybe 98% of the rest of the individuals who are out there that have saved money, they don't know how to do it. They don't want to know how to do it. Mm-hmm. They want somebody to do it for them, right? And so for you, I know some of you are thinking, hey, my neighbor went to cash. Should I go to cash? Or you heard Kramer last night saying, hey, opportunity. Are we in recession? Should you be selling? Oh, I've got some great stocks for you to buy. Now they're on sale. And you're trading on that noise. That is not a plan. That is the worst strategy, because what will happen is as soon as you get in, what if the market goes down? You panic, you get back out, and then you're hurting yourself for the future. You're not trusting yourself. Therefore, you're sometimes making very emotional decisions and you're doing nothing. And now you're sitting in cash too long and you're waiting and you're waiting and you're waiting for the next market decline, whether it's 5 or 10%. And when that market does decline 5 or 10%, do you really honestly think you're going to go back into the market when that happens? And 99% of the time, people do not. They wait and they sit.
Mm-hmm.
And then it runs back up and you miss the opportunity. And then you're scared to get in because you feel like it's going to come back down again because of different noise makers out there. Yeah. And so it's not a strategy. It's not a good plan. But I will say, if you have a good advisory team that you're talking to and they're saying, hey, do it now, or this is a great idea. Here's some stock picks. We'll do it for you. Or if you have a relationship that you just pay a fee and then you do it yourself, those are the people I want you to be talking to, right? Not all advisory firms or brokerage firms out there do that. So when you are working with them, you need to know what is their policy. Can you call and say, hey, Charisse, I really want to buy Apple stock. Can you go ahead and buy it for me? Or should I go ahead and buy it in a portfolio if you have trading privileges? And that conversation has to happen, but don't do it on your own. I truly believe you should not go alone in retirement, especially if you're living off those dollars and you're chasing returns. So that's an emotional way to invest, and emotions make bad decisions.
Well, the old saying is there are those that can't market time, and there are those who don't know they can't market time, you know? It's just, you know, you and I have a mutual friend. His name is Brad Jenkins, and I know that we're going to be talking a lot about him in the coming months and years.
Yes.
Because you're kind of working with him. And one of the things that Brad's got on his website, he's got this little pie chart, and it says, how do most people achieve their financial success? And you would think it would be, oh, they bought, you know, Coca-Cola years ago, or they bought Microsoft, or they bought Amazon, or they got in on the ground floor. And when you look at that pie chart, market timing is absolutely like 1% of people's success. The major success for people in their financial lives is their portfolio construction. It's where you are, what your risk level is, who you have helping you, and staying the course. Now, I'm not looking at you now and I'm saying, hang in there, it'll come back. That's not what I'm saying at all. What I'm saying is that you got to get a handle on what you're comfortable with as far as the market concerned. If you want 30% in or 20% in or 10% in, whatever it is, you get that set, and then you feel comfortable. If this market does these things, you're not, you know, calling Charisse from your Mediterranean cruise going, am I going to have enough money to get back? And, that's not what you want in life, is it?
No, you don't. We want you to go on your trips, be at ease, spend time with the grandkids, not having to yell at your advisor while you have them in the kiddie pool saying, what are you doing? No, your kids are too young. Your grandkids are too young to hear that this early.
Right. You're right.
Having a plan is key. And we're really excited about Brad Jenkins because I've been working with him for 15 years. And we had many conversations over the years about active management, sector rotation. And I said, hey, I'll work on active management, doing sector rotation on a monthly basis. And he's like, I'm going to go daily. And he's winning all the awards. So we're finally teaming up with him. And the awards are just outstanding. So we're really excited to sprinkle in his daily activity of managing during these volatile markets because, you know, the goal at the end of the day is potentially maybe we can have a higher return. Potentially maybe we don't have as big as losses. But without a plan, without some math put into it, without algorithms and formulas on part of the portfolio, I just feel like we stay balanced, we keep a structured portfolio, and we have 5 things working 5 different ways because we don't know what's going to happen tomorrow.
Well, one of the things that Brad talks about and we will be talking about, and we have talked about over the years, is taking the emotions out of your investing. It's a nice thing when your retirement is exciting and your investments are boring. That's kind of what you want. And we're going to take that emotion out of things. You like that?
Can I tell you, like, this has been the hardest lesson. Boring works. Like, you guys, I'm an entrepreneur. I am a visionary, and I have staff that just say, Charisse, we got to slow down, or we can do this. And listen, boring works. I have had a hard time with that in this industry. And what I've learned over 20 years is that all my mentors, all my coaches, they're right. Yep. Boring actually works. And there's no like sparkly object. Just be consistent, be a customer service, savvy, and be up to date with what's happening and be a forward thinker. But boring is good. So if I can't convey that a better way, it's funny because I got a big smile on my face because I don't know how many times I've heard that.
Well, imagine you're in retirement and you're having breakfast with your friends, or you're down at the health club and you're talking back and forth, and they're all worried about the market going down 1,600 points, and you're going, and I'm just not even a part of that conversation. That doesn't even bother me because I know what my financial plan is. I know that the monthly number is coming in no matter if the market is up or the market is down. That's really what you want, and that's what our goal is to have for you with our Portfolio X-Ray. We'll do it for you at no charge. Give us a look on our website. Give us a call. Let's get going. Get a date on a calendar. ZinniaWealth.com, ZINNIA Wealth.com is our website. There's a gold box down at the bottom. It says complimentary retirement consultation. Just click on that. You'll be on your way. Or call us at 833-368-3680. 833-368-3680. We'll take a break, and we'll come right back with more Retirement Coffee Talk. Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, ZinniaWealth.com, ZINNIA Wealth.com. Hey, while you're there, you'll see the navigation bar up at the top of the website, and it says Events. When you click on that, you'll find out where Sharice is going to be doing Zinnia U. This is meetings, instructional meetings to talk about retirement. And if there's a date there that looks good to you, give us a call and get signed up. You can also give us a call on that as well. These are free events, and they're an event where you can say, I got this question about the markets. I got this question about inflation. I got this question about taxes. All these different things that you want to know about. Give us a look. 833-368-3680. All right, so I mentioned before the break, we talk about diversification. And to me, that means, you have a little bit here and a little bit there and a little bit here. Not all your eggs in one basket. And most of the time, that's talking about investments. But Sharice, there are 3 different kinds of buckets when it comes to taxes. And we talk about tax deferred and tax free and taxable. And so we need to think along the lines of that as well. Talk to me about how you feel about going into retirement with all 3 buckets. Should it mainly be a tax free bucket? What is it that you approach the tax question? How do you do it?
Yeah, so let me go backwards a little bit and just talk about the buckets. Okay. Because some people might not understand there's actually 3 tax buckets, and some of you are like, what does that even mean, Sharice?
Okay, good.
So 3 tax buckets. Let's start with the simplest bucket. Most people have a 401k. Or if you're self-employed, you have some sort of self-employed, a simple IRA or something like that. That is, we call it a qualified tax bucket. That qualified tax bucket just means you are qualified to be hit with taxes one day at a probably much higher rate than you're in today, based on whatever your income rates are in your marginal tax brackets in the future when you're retired. So that's my little joke, but it's really the best way to understand that qualified tax bucket. So those are your IRAs, your 401ks, 403b, 457, TSAs, TICREFs, those types of accounts, and they typically start at your employer's office. Now, the beauty of that tax bucket is that whatever dollars you put in that 401k when you're with an employer or retirement account, if you make $100,000 in income, Randy, and you put $20,000 into your 401k, the beautiful thing is that $20,000 will grow tax deferred to the future, and you don't pay the taxes on it. And on top of it, you get a double positive. And if you make $100,000 and you contributed $20,000, well, you're only paying taxes on $80,000 of the income that you brought in because you were prudent and were doing the entire government a favor by saving for your future retirement, right? So it's a great thing to have. But the big myth out there is that when you retire, you're going to be in a lower tax bracket. And for 7 out of 10 people, that was not the case. This was an assumption based on math that didn't end up working out the way the government thought it would. So that's your tax deferred bucket. And you will have to pay taxes on all of your contributions and all the growth one day when you pull money out. And that's typically over when you're past the age of 59 and a half. Okay. Now let's talk about the taxable bucket. This is the second one, and is another very easy way to understand how this bucket works. We call it a non-qualified account. It's going to be taxed differently. So let's say you sell a home and you said, hey, well, I've got 200 grand. I want to invest that money. In those dollars, you might buy a bunch of stocks or whatnot, right? That means that one day, those dollars, when you sell that stock, let's say you have Apple and you're like, I need $10,000 in income and I'm going to sell that Apple, and you put 10 grand in there and now it grew to $20,000 and you need 10 grand. Well, it's going to be taxed based on capital gains rates. It's not the same as those retirement accounts that you have, because those are taxed differently at marginal ordinary income rates. So it's two different strategies to be taxed. So here's the positive. Let's say that Apple grew to 10 grand from the 10,000 you put in. You need the 10,000. The 10,000 you originally put in will never be taxed again, right? So that's the nice part. But the growth will be taxed at capital gains rates. And if you sell that Apple before exactly 12 months in one day, you're going to have short-term capital gains rates, which historically are higher than your ordinary income rates for many people, not all people. And if you wait to sell that Apple stock 12 months in one day, you're going to potentially have a better tax favoring, and you'll pay less tax on it by waiting that extra day. So again, for most people, not all people, this non-qualified taxable bucket can be in your favor to have money saved in those accounts for the future, especially if taxes are on the rise, versus having all your eggs in one basket in that 401k and IRA, which is typically taxed at a higher rate, right? Again, come in and see us, because everybody's going to be a little bit different. So that's two tax buckets we've talked about. Now, the third tax bucket is the tax-free bucket. The tax-free bucket is your Roth IRA. Every dollar you've put in it, you've probably already paid the taxes on it, right? So all the growth is tax-free. So one day when you pull money out of it, as long as you've had it for 5 years and you're 59 and a half and older, you pay zero taxes on it. So let's go back to Apple. So if you bought $10,000 worth of Apple, and over the next 5 years it grew, for example, to $100,000, and you're 59 and a half and older, and you're like, I'm cashing this puppy in. I want to go buy an RV. This is what this 10,000 was for. And you decide, I'm going to cash out the 10,000 I put in and the 90,000 it grew. There's zero taxes on it. Isn't that amazing, Randy?
Yeah, the Roth is a powerful thing, isn't it?
It is. So I truly believe that by default, you're always going to have that qualified 401k IRA bucket, and you're always going to have to pay taxes on those dollars, right? Most likely, especially as taxes go up. But why not sprinkle in, while you're growing your wealth, a Roth IRA, so you also have something to pull from that's tax-free? And then why not sprinkle in this non-qualified bucket, where we call it the taxable bucket, so that we can take opportunity when opportunity presents itself? Because we at Zinnia Wealth Management, we do tax planning, and we love and encourage something called tax loss harvesting. Because if you sell 10,000 of that Apple stock because you need cash, we can actually strategize and sell maybe something else in that account that maybe took a loss, that we can reinvest those funds into something that's going forward and moving and maybe having a higher return potentially. And you pay zero taxes. So a lot of firms, they're a deer in the headlights because they don't want to do that tax planning. And I feel like in retirement, if we don't have that resource for our clients and we're not doing that, we're losing dollars. So all three are very valuable, but 99% of the people retiring today, Randy, 90% of their dollars are in the one bucket called the 401k, the IRA, the retirement account, where all of it's taxable. And so right now, there's no better opportunity. I mean, think about it. If your Apple stock went down, take the opportunity. Maybe it's time to go buy a couple more of those apples, right? I'm not telling you to go buy the Apple phone. I'm like the Apple stock, right? Again, don't trade on any of these words coming out of my mouth, because you need to come sit with me.
Okay, so
this is just, go ahead.
I got two questions for you. Well, first I'll say this. You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth, and we're having a conversation here about 401ks, and we're talking about taxable buckets, and there's the tax-deferred bucket like your 401k, the tax-free bucket like your Roth IRA, and the taxable bucket like stocks. Now, If you are, let's say, for instance, hey, this is what I did. I don't know if I was right when I did this, but I got to be in my late 50s and I saw all of my money's in a 401k. Well, then all of a sudden, my employer made available to me a Roth 401k. And I said, you know what? I think I have enough money in that tax-deferred bucket. I'm going to now put all of my money into that Roth IRA bucket, that Roth 401k bucket.
The tax-free bucket.
Right. So is that a good move for people who are on that runway to retirement, maybe 5-7 years out, that you look and you say, I don't want all my money to be tax deferred. I want some of that tax-free money. So now at this point in my life, I'm going to move it all over there.
Well, I'm going to answer the question like a politician.
Okay.
Do you feel taxes could go up in the future?
Most definitely.
Could they double?
Surely.
Then moving IRAs to a Roth IRA is the next thing, the closest thing next to the white sliced bread.
Okay,
right?
That's a good thing.
Right, but
right.
I know there's some people listening. They're like, but Cherise, my income is $200,000 a year or $150,000 a year. If I contribute to this Roth, I don't get a tax deduction. If I contribute, $30,000 to a 401k and I make $150,000, I'm only paying taxes on $120,000, for example. Mm-hmm. So I understand that. So don't make a decision based on this conversation. It has to be a one-on-one where we're really digging in, figuring out what your goals are, seeing where you're at. When are you going to retire? How big is this tax problem going to hurt you if you are working and you don't get the deduction anymore? And is the value worth it over the next 30 to 40 years of your life in retirement? And most of the time, the answer is it is worth it. But again, I get one-offs, and every once in a while, I'll get an anomaly. And I was like, maybe we need to focus on this, and we can focus on the Roth idea once you've retired and income isn't so high. And there's so many things that play a role in our decision-making, and it's not cookie cutter. And if I can implore everybody to come in for that tax plan, you won't regret it. It is worth it. We don't charge a fee for it. And just at least open up that connection and that vision appointment to say, do I or don't I?
Give us a call. Give us a look on our website, 833-368-3680. We'll do that portfolio x-ray for you. That will certainly include a look at your tax situation and your tax liabilities. Are you heavily weighted in this area we call tax deferred? All of your money is in a 401k. Or do you have that Roth 401k or a Roth? Do you have that kind of money? Should you go into retirement with all three of the different buckets tax-wise? Great questions. Let's get you those answers. Here's our number, 833-368-3680, or use ZinniaWealth.com, ZINNIA Wealth.com, and click on the gold box there that says complimentary retirement consultation. Well, Cherise mentioned that school is back. It is school bells once again, and it is interesting when we talk about education here on the show, we're talking about financial education. There was a new study from Edward Jones that found that 80% of American adults never received any financial education in school. Now, let me ask you about that, Cherise. I mean, at my high school, I had a kind of a weird high school. It was kind of an experimental kind of thing. And we had a class, it was called GE, General Education. And in that, it was an hour every day, maybe an hour and a half every single day. And it just cut through all sorts of different life skills, even like dealing with death. You're talking to 15-year-old kids, 16-year-old kids. You're going to encounter this sometime in your life. Here's what grief is all about. And it was things like that. One of the things that it also talked about was how to balance a checkbook. This is how, it was a little bit of financial education. I got that in school.
Wow.
Now, did you get anything in school that talked about finances at all, economics, anything like that?
No, sir. No, I did not.
Yeah.
And I think there was a couple of lost decades where we're having to play catch up, right? When I was going to school, it was all about recycling.
Oh,
right?
Interesting.
Save the planet.
Yeah.
Turn the water off when you're brushing your teeth. They had these different cartoons out there, and they pushed it in schools, which is good. But I'm not sure how much that helped because our ozone is being ruined right now. So if I had to choose learning about protecting our earth, which should have been part of it for sure, the finance world I think we could have been in a better place 20 years later, because those dollars and the cents we would have gained from that would have already driven money to saving the planet, right?
Yeah.
And that would have just come, because in college we're all about protecting and saving the planet and what's fair, and that would have come. So recycling is a big deal. But I think what happens, and it's really nobody's fault, it's money flow, and schools get cut back and they don't have the funding. I remember we were doing music and then they cut out music, and that was like the one thing I looked forward to. I remember when they were cutting out PE. It's funding, and it hurts the kids, and the kids out there in these schools, they need to protect the future and make sure that funding is always there and is always an issue.
Well,
and that's the stock market. That's the economy based on decisions that we cannot control, and it hurts each decade of children that are aging out of high school. So again, there's no blame. It's just, I wish I had it. Financial literacy is key. And thank goodness for DeSantis, because he has made a rule, and all schools now have to have the financial class. I don't know if you know that. So I'm very optimistic to this next demographic growing and understanding finance and saving our world in 30 years.
Nice. Well, this is one of the reasons Charisse does Zinnia U, is to do just that, because as you've gone through your life, you've learned to deal with whatever finances that you have. You've learned to save. You've learned to deal with your monthly budget. But then you get into retirement, and it's all different because you're not working anymore. And all of a sudden, you need to survive on what you've done, what you've saved. How does that work? And many of us don't know. I mean, we just had a segment there about the different tax buckets. There's 3 of them. Did you all know that? Maybe you did, maybe you didn't. But Charisse, let me ask about I hate to use the words, but the retirement IQ or the financial IQ of people who come in to see you. Is it more concerns? Do you see people that they're asking questions about Social Security? They're asking questions about the market, the difference between an ETF and a mutual fund. All of a sudden, we have to know these things because our literal financial life and our retirement life really depend on it, doesn't it?
It does. One hazard can lead to another hazard, which can lead to a domino effect of negative compounding problems. And, even in our class, we're there to educate, and that is it. And we talk about the tax buckets, and we bring it in. We try to make it very simple. And we compare what is a mutual fund to an exchange traded fund and index fund. And we talk about the tax buckets because most people who come into our office, they have that non-qualified, that taxable bucket in a mutual fund. Mm-hmm. And I know I'm working with a rookie advisor when they're coming in, because you wouldn't do that, because you get these surprise capital gains reports every time that mutual fund makes a sale, and you're like, hey, I got a capital gain for selling Coca-Cola, and I got to pay, $4,000 on this? Depending on what your weight was in that fund. When you could go to the exchange traded fund with that taxable bucket, and when they sell that Coca-Cola and buy Pepsi or something, you don't pay taxes on the deal. And so we're very tax savvy when it comes to making sure your investments are placed. Every investment has a different strategy, and the right investment in the right tax bucket is also very important. And I think a lot of advisors out there skip that part, and I just don't. I think it's very valuable, and it's important.
You're going to come with your questions, and that's really what we would love. I think that many times people say, I don't know what I would talk to a financial advisor about. I don't even know what to ask. Well, ask those questions. If what is tax deferred? What is tax free? What is taxable? How much money should I have in the market as opposed to outside the market? What are my options outside the market? I heard stocks and bonds, and that's all I know. It's okay. Everybody's pretty much in the same boat. We would love to be able to help. Give us a call. Give us a look on our website. When you go to zinniawealth.com, hit the thing on the navigation bar that says events, and then it'll open up our calendar, and it'll show you the next Zinnia U opportunities there. We have a couple in the month of August. If these don't work for you, we're always doing them more. It will be in September. We'll have other locations and other times. So give us a look. Zinniawealth.com, ZINNIA wealth.com. But if you'd like to just sit down with Charisse and just talk through your situation personally, let's do the math on your retirement. 833-368-3680. 833-368-3680. We'll take a break. Come right back with more Retirement Coffee Talk. Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com, or give us a look at 833-368-3680. Get that time so you can sit down with Sharice and talk through your concerns about retirement. And it's always good when we get together and you tell me, okay, this happened at Zinnia U this week, or this happened in the office this week. This was an interesting conversation we had. And so you would think that people would come in and most of their concern would be about investing. And then we talk about how the dominoes continue to fall and the conversation goes to taxes. And then after it goes to taxes, then it goes to legacy planning. And then it goes to, well, what if I get sick? And these are real concerns of real people. And you had somebody come in this week and they wanted to talk about long-term care.
Yes. And I thought it was valuable to bring this up because I personally have not talked about it in a very long time. And people are screaming and upset about long-term care policies they bought 10, 15, 20, 25 years ago, because whether you have John Hancock or Genworth or Mass Mutual, you're starting to see premiums go up. And some of you have already seen your premium double from the day you bought it. And you're wondering, well, should I cancel this and buy life insurance instead? And there's a lot of noise out there. I don't go alone making this decision, but I got to tell you about a client of mine. They've been a client of mine for 10 years. And I see him a couple of times a year. And they called Mary at my office. She has an insurance license. She's been with us for years. And said, Mary, I hear Sharice on radio all the time talking. And last time we were in the office, we told her that premiums on Genworth were going up and we can lower the premium by changing the benefit package and or keep a higher premium for the same benefit package. And I said, when you get the new stuff, send it in to us. We'll review it. And they were going to make a very bad decision. And I called them and said, hey, before you make this decision, we need to talk it out because there's something you need to know. Because when you buy a long-term care policy, the state of Florida and other states said, we're going to reward you because you took the initiative to pay a premium to take care of your care duties so that Medicaid and the state doesn't have to come in. We're going to reward you. And it's called the Florida Partnership Program. And I learned this years ago from an advisor that I even look up to today, fantastic advisor, and he wrote a book on it. And what it's about is, let's say, I'm going to give you the exact example of this client of mine, a couple. They bought a long-term care policy when they were 54. They are 73, 74 right now. The benefit was $600,000, okay? And it said the policy will pay out $600,000 over 6 years. So they had some issues with family. Family was in long-term care, so they were just being prudent and trying to take care of themselves, so nobody else had to. But their premium has doubled. And now they're wondering, is it worth it? So the Florida Partnership Program just says, listen, if you buy a $600,000 long-term care policy, if you are in the nursing home and you have dementia and you're in there for 10 years, after 6 years, or even sooner, most likely, that policy will be gone. And then Medicaid will come in, and usually you can stay in that same nursing home. So if you had to stay there for 4 more years, Medicaid says, okay, we're going to take part of your income from the spouse that's still in the house, so they're going to lose income. And then we have to spend your assets down to a little over $125,000. So it leaves the spouse in the house very destitute. But the Florida Partnership Program says because you bought a $600,000 policy, the spouse in the house only has to spend their assets down, not to 125 and change, but will allow them to keep 600. So again, it's a mouthful. I need to write a white paper on this and send a blog out eventually here in the next month on it because it's very valuable. And I said, listen, if you have an inflation rider on your long-term care policy, whether it's simple or compounding, that makes the difference. So if you are under 61 years old when you bought the policy, to have that Florida partnership be part of the program and what you've done so far, you need to have compounding inflation increases. If you got it at age 61 to 75, you only need simple. And he was about to go with the option where he would get simple inflation increasing benefits every year. And if he had done that, he would have been pushed out of this Florida Partnership Program, which he didn't even know about when he first bought it, right? So again, know before you go. I have so much information in the little beady head of mine that I can't ever get enough out, but we're talking to clients before you sell this, because a lot of people didn't buy inflation when they got these. So then there's no point in talking about it because they can't get it anyways. But the people who did, come in and see us. We will do a long-term care x-ray. We'll do your home health care x-ray. We'll look at all the benefits you have. Does it make sense to have inflation or not inflation? Does it make sense to cancel your policy or keep it? And to really understand, are you or aren't you part of this Florida Partnership Program? Because it is a free money, in my opinion. I don't know if I can legally say that, but it is money that gets to stay in the house in case you are in a nursing home for very long term. And it keeps that spouse still in the house being able to continue the things that they're doing on the daily without crippling their future. So again, I'll stop talking about it now. Go ahead.
It's always good to have somebody on your side when you're coming up against a big decision like that, whether it's your 401k, some kind of an investment conversation, or something like long-term care. Medicare for sure, and we're going to be talking a lot more about that as we get toward the Medicare window that starts in October. Give us a look on our website, ZinniaWealth.com, ZINNIA Wealth.com, or 833-368-3680. Charisse, that is all the time we have. I'll give you the last word for today.
Thank you all for tuning in. We had a mouthful of information today between markets and taxes and the Florida Partnership Program with long-term care. If you missed any of it, go to our podcast on YouTube, Apple, Spotify, iTunes, you name it. We're almost on every outlet. And tune in, because this week there was so much going on and people are stressed out, and we want to calm the chaos in your homes and just have a nice conversation about what we're thinking. Thank you all for tuning in. Live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at ZinniaWealth.com.
Charisse Rivers is an investment advisor representative of Zinnia Wealth Advisory, LLC, a registered investment advisor. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Charisse Rivers is licensed in your state, please contact their office. Zinnia Wealth Advisory, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. Any client experiences discussed during this show are unique to that client. They are not meant to imply or suggest you will experience the same results. By contacting us, you may be provided with information about insurance and annuity products offered through Charisse Rivers, NPN Insurance License Number 8718011.